So picture this. It's the end of 2025. You look at the Bitcoin chart, and honestly, it's not pretty. Sure, it hit a new all-time high, but then it just bled out for months. Stagnation, right? But then you hear Michael Saylor, one of the biggest bulls out there, saying it was actually the best year in Bitcoin's history. Wait, what? How can both of those things be true? What's the story the chart isn't telling us?
All right, so this really sets up a tale of two charts. You've got the market versus the mechanism. It's the story everyone sees on their screen every day versus the story happening behind the scenes in the very plumbing of the system.
And here it is, laid out plain as day. On one side, what the chart showed us, a new high and then a painful slide down. Everyone was calling it underperformance. But on the other side, you've got Michael Saylor saying, and I quote, the best 12 months in the history of the industry. I mean, come on. He's not just being a little optimistic here. He's saying it's the best year ever. So this isn't just a different opinion. It's like they're looking at two completely different assets.
So that's the big question, right? Is Saylor crazy, or is he just seeing something everyone else is missing? Is the entire market just measuring the wrong thing by being so obsessed with the daily price? Well, that's exactly what we're going to dig into.
Okay, so here's the core idea. The foundation came first. The argument is that 2025 marked a fundamental shift in how Bitcoin's market cycles work, because for the first time ever, the serious, heavy-duty foundation was built before the price went on a... I mean, think about the old way this worked, the old paradigm. In every single cycle before this one, the plumbing was always late to the party. The price would just explode first, right? Think back to 2017. Price goes crazy, but there's no real institutional custody. Or 2021. New highs again, but still no spot ETFs. And the big banks? No way. They wouldn't touch it. It was always speculation first, and the grown-up infrastructure had to scramble to catch up later.
But in 2025, well, that whole script just got flipped on its head. The foundation was built first, while the price did pretty much nothing. All of that incredibly important heavy lifting, the regulatory stuff, the banks getting on board, the credit markets, it all happened while the price was just going sideways, driving every trader crazy.
So let's get into the details. This brings us to the institutional checklist. What were these huge structural shifts that happened while everyone was just staring at the chart? It wasn't just one thing. Believe me, it was a whole series of dominoes falling into place. Okay, first up, and this one is a biggie, regulatory green lights. For the first time, you had a supportive administration pretty much across the board. President, SEC, CFTC, Treasury. You even had David Sachs come out and basically say, look, Bitcoin is a digital commodity. It's an asset without an issuer. And then maybe the most critical piece, you get this favorable guidance from the IRS on unrealized capital gains. That's a huge deal, removing a major fear for anyone holding long-term. Next on the checklist, market upgrades. I mean, the mechanics of the market itself got a massive overhaul. The spot Bitcoin ETFs, they were finally uncrippled. This allowed for what's called in-kind creations, which is just a fancy way of saying huge players could now swap actual Bitcoin for ETF shares seamlessly. It's a game changer for liquidity. Then you have the onshore derivatives market. It just exploded, going from $10 billion to $50 billion once the old restrictions were lifted. And to top it all off, the CFTC officially gave the nod for spot Bitcoin to trade on regulated exchanges and be used as collateral. Each one of these is a massive upgrade to the system's pipes. And then the banks arrived. This was the final critical piece of the puzzle. After count 'em, 6 rounds of positive guidance from the regulators, the dam just completely broke. We're not talking about them just testing the waters anymore. No. Suddenly, the biggest names on Wall Street, JP Morgan, Charles Schwab, Citi, BNY Mellon, they were all jumping in with both feet, announcing custody, credit, and trading services. That, right there, is the ultimate seal of approval from the traditional finance world. Okay, but this is where it gets really interesting. All of these different pieces we just talked about, they don't just exist in a vacuum. They combine to create something brand new and incredibly powerful, what you could call a credit absorption engine. And this isn't just another bell or whistle. This is something that fundamentally changes the math of Bitcoin's supply. And Michael Saylor really just nails it with this quote. He says, you're looking at a $2 trillion asset class that's been unbanked. Just think about that. For its entire life, Bitcoin was this huge asset that you couldn't really use for credit in the traditional system. And as he says, as you watch the formation of banking credit, that's going to be a big driver.
It's basically about unlocking all that value that was just sitting there and turning it into productive collateral on a massive scale. So to really get how powerful this is, let's just start with a simple number. $16 billion. That's roughly the value of new Bitcoin that miners create and sell onto the market every single year. You can think of it as this constant, predictable headwind of sell pressure that the market has to soak up just to keep the price from going down. Now here's the mind-blowing part. If just one of these big new banks creates $16 billion in loans backed by Bitcoin, they have effectively removed an entire year of new supply from the open market. See, that Bitcoin isn't getting sold. It's being locked up as collateral. This is a whole new engine for absorbing supply that is just on a completely different level than anything the market has ever had before. Just let that sink in. 1. The number of major banks it takes to completely neutralize all of the annual selling from miners is just 1. A single institution, like a JP Morgan, has a big enough balance sheet to do this all by themselves, just through their new credit business. That isn't just an improvement, that's a completely different game. And now imagine 10 of them. Because remember, it's not just one bank dipping its toe in the water. We're talking about the entire traditional banking system getting the green light to come play in this sandbox. So what happens when you have 10 or more of these giants all competing for this business? The amount of supply that could be absorbed off the market is just staggering. So let's just put it all together. The old cycles, they were all about price leading and infrastructure following. It was retail-driven, chaotic, and the serious money was always playing catch-up. The 2025 setup? It's the complete opposite. Infrastructure is now leading, and price is the thing that has to follow. It's institutionally driven from the ground up. And this huge, growing gap between the powerful new foundation and the boring old price, well, it leads us to our final idea, the coiled spring. It's a perfect metaphor for the tension that's been building up in the market. Yeah, this massive gap between everything that was built in 2025 and what the market is actually pricing in has created what you can only describe as a coiled spring. Think about it like that. All this incredible potential energy from the new regulations, the market upgrades, the banks, it's all been packed and compressed into the system, but the price hasn't moved yet. That spring is getting tighter and tighter. Which brings us to what happens when that spring is finally released. As the quote says, history shows that when the foundation gets this far ahead of price, the repricing isn't gentle, it's violent. When you see a disconnect this huge between fundamentals and price, history tells us the market doesn't tend to just slowly drift back into alignment. The catch-up can be, well, pretty dramatic. So, the final question is this. When that repricing finally happens, what does it look like? If this coiled spring theory is right, and the market suddenly wakes up to what was built in 2025, is it a slow, gentle drift higher? Or is it a violent gap up that catches every single person who is just staring at the old price chart completely and totally by surprise?